The right debt doesn't just finance a deal, it shapes the outcome. Because even strong deals can fall apart with the wrong financing structure, and small decisions around debt can have a major impact on risk, timelines, and returns. And for both investors and operators, understanding how to evaluate and structure debt is a critical part of making confident, well informed decisions. In today's episode, we'll discuss our goals in raising debt, what we look for when selecting debt on a project before we even make our offer, how interest rates, timelines, and flexibility can impact the risk profile of a deal, how we model debt in build to rent versus build to sell scenarios, how we use debt to increase your returns for equity partners, and how the wrong structure can create pressure on an otherwise strong deal. Because the right debt structure gives you control, stability, and the ability to execute, while the wrong one can introduce unnecessary risk. And going forward, understanding how debt works allows you to evaluate deals more clearly and align financing with long term success. So let's dive into it. I want to start off first talking about how do we judge a lender. We traditionally think of origination points, et cetera, that kind of stuff. And that's exactly what we want to talk about. So, Devin, what kind of things are super important when we're looking at lenders and their terms?
Yeah, those are like those are numbers. Those are the easy ones. The first when you talk about origination and extensions, other fees, their draw fees, things like that. A lot of things a lot of people also don't think about are the qualitative that we really should be discussing. Does their draw take 24 hours or does it take a week? Is there an inspector? Do you have to do additional work? Things of that nature when it comes to ease. And then one other thing that we talk about a lot is like, have I already done a deal with them? Is something that we really highly value because we know execution risk goes down if we've done a deal with you already.
Okay. So obviously, leverage, origination, these kind of things are important. And you're also mentioning that the qualitative components are important. How would you evaluate working with a lender that you've maybe worked with before when there's a lender that you haven't maybe offering you a half a point cheaper on the origination?
Yeah, it depends on the risk reward, and for me, a lot of times it's what's the setting on the timeline. If we're closing in 3 weeks, I'm probably not going to use a new lender. I want to know that this closes and that I'm not going to have any delays. That's something that we're just not willing to risk in a lot of scenarios like that. Versus, say, like the deal we just closed on some raw land, we bought it cash. We have some flexibility to try to optimize on the debt while we're getting the permits in place on that one, and we can better look at a new lender.
Okay. So things like timeline, things like complexity of the deal, that impacts whether or not you're willing to step out of your comfort zone and maybe try a new lender. What's kind of your threshold here? So if we could get, if we're working on a 6 month loan and maybe someone is a full point cheaper than someone else, that's really 2 points annualized, right? Does that start to interest you a little bit more?
Yeah, it's usually, I mean, you're asking an extreme scenario. It's usually not that much for
Mhm.
something like that. And especially with us, when like, quite frankly, we've closed loans with, enough people where a new lender is not going to be able to compete necessarily like that. But yeah, it gets interesting. I think we did it recently on a deal where we were getting a development loan and we felt pretty comfortable and getting over that hurdle because of how aggressive that lender was willing to be on the Sherman duplexes deal over in Raleigh.
Yeah.
It was like, yeah, we paid up for that because it saved us so much equity capital.
Yeah, that makes sense. We did go with a new lender on that deal, but we kind of took our time in doing that, explored that relationship, and also created that relationship with the lender prior to being under contract, right? This wasn't just we had a quick close, it was we already had this relationship and we're looking forward to doing a deal with them, right? So we had the background. One thing before we move on to the next point, one thing that I think a lot of people don't think about that you mentioned is extensions. I think in today's sort of uncertain environment, right, extensions can be important. How do we generally take extensions into consideration?
Yeah, it depends on the style of the deal, especially like say something like a build to rent where you're going to refinance afterwards. Those extra 3 months or so can be very helpful. Or I mean, sometimes just asking for it on the front end. They issue a term sheet for 12 months, and you're like, you know what? Can you do those same exact terms, but just do me out front on 15 months or 18 months? And trying to take care of it on the front end, because like right now also, like, say you go to sell something and you're struggling because we started bombing Iran and interest rates went up half a point and there are fewer buyers out there right now.
Hmm. Hmm.
um Maybe you want to switch your strategy to a rental refi. You just need that extra 3 to 6 months, and understanding what the cost is on those extensions, just so that you have options on the back end just in case you have to change up a little bit.
Yeah, so the style of deal that we're working on can also impact extensions, and it just kind of helps generally, I think, to be conservative in our assumptions, right? With everything we do, we're conservative. So if we think, okay, it's going to be 3 months of development, 6 to 7 months of build, even if we're selling and we think it'll take 2, 3, 4 months to sell, that adds up to around 12 months. We'll try and get a 15-month loan, right? Because we don't want to have to pay. But sometimes we're presented with a 12-month loan with the opportunity for a cheap extension. We like to make sure that that flexibility is there.
Yeah, yeah, especially if they're like, "Oh, it's gonna be 1 point and your extension for 3 more months is gonna be a quarter point." It's like, "Okay, I effectively have an 18-month loan here for 1.5."
Exactly. Exactly. So that's like check, 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 right? These are things where we're just getting the basics out of the way. Origination, points, extensions, like even relationship seems bare bones. Let's move on to what we sort of do differently than other people and why we think debt is so important. We generally think about debt before we even make our offer, right? There are things like we do a bunch of different types of deals. We do tear downs, we do rehabs and subdivides. We'll do build to rent, whether there's an actual subdivision or it's already subdivided. There are plenty of different factors going on here. So, what are some different ways we're thinking about debt before we even put in an offer on a property?
Yeah, we're for that style of deal, we're already thinking we've already managed a bunch of relationships to know what the boxes are of potential lenders so that when we look at a deal, we're like, "Okay, well, it has a house on it. I know that these 3 lenders really like existing properties that subdivide off of it, and they can give us lot credit or something like that for that particular scenario." Whereas other people, maybe it's just raw land development and a lot of lenders won't touch it. And so we just know that, okay, we have to talk to just these 2 or 3 people who understand our strategy already, and here are the terms that they're probably gonna give us because we already discussed with them on a previous deal.
Yeah. So it's kind of important for us to have these relationships in advance, talk to all of the lenders, and get a feel for what kind of deal we would use them best for, right? So that's really important to us, and I think we'll touch on that a little bit later. But more specifically, like let's talk about deal types. Most of our deals are by right development, right? That's where we think the money is. That's where we're more profitable without increasing our risk substantially. That's like our bread and butter. So, what are a few examples of how we would use one lender on one type of deal versus another?
Yeah, yeah, because we say by right development, but there are a lot of different types of deals even within by right development. I mean, if you there are 100-unit communities that are technically by right. Just to have a key differentiator here, is there an existing structure that you intend to utilize? And are we going to actually rehab it? We're looking at deals where right now it just doesn't make sense for us to even do the rehab. So are we buying this property? We're going to subdivide some lots off of it, and then we're going to try to flip this house or rent it out. Those are some of the variables that go into that a lot of lenders right now are willing to get very aggressive on when you do that. And so that financing can much more multiply your returns on a potential deal versus not having a structure to leverage on a property.
Yeah. So when we're and I think that's great, right? When we're tearing down a house, for example, and let's talk about like our 601 West Markham deal, which is now on Washington, where we bought a structure and our plan was to tear it down and build 3 new houses. We essentially are buying land. And lenders' terms are different on land than they are on existing structures. When you're keeping them, you are essentially, in their mind, destroying value, right? And so, our experience with lenders, we understand this topic, we understand this concept, and we are going to manage our relationships in advance to put us in a position to reach out to people who also understand this in the way we understand this. Whereas if that's not something we were doing, we would maybe reach out to like a more traditional hard money lender. So this actually reminds me of when you and I went out to look at this property we're under contract on Alcott in Durham. And I said, you know what? This is a good deal. I like this deal. I see it here. And then I think it can be profitable, but it's not a home run. And you immediately jumped in and said, but we're keeping the house. And keeping the house allows us to leverage our financing and get us more money on the front end. And that increases our returns for our investors, right? Can you talk a little bit about how that made a deal from a good deal to a great deal?
Yeah, I mean, and that one is a great example where like we're trying to do as little rehab as possible. We don't
Mhm.
actually want to make money on the house. What we want to do is get 2 lots off the back, where we're going to develop our duplexes. And when it comes to leverage on something like that, I mean, we basically could come out of pocket maybe $15,000 to $20,000, and if we can successfully just offload the house, we get 2 lots for $15,000 to $20,000. Whereas if we were just tearing down this house, there's no way we're getting a lender to be like, okay, here you go, here's 90% plus loan to cost, at a 75% of ARV. And that increase in leverage, an extra $20,000, $30,000 out the gate that we're having to pay 9% on or something like that, 9 to 10%. I mean, it's tremendous when you look at what the levered returns are, especially also de-risking. I mean, we're talking about 3 to 6 months getting rid of this house and giving us a lot more flexibility than to own 2 lots free and clear where we've got, what, a dozen, 2 dozen, 3 dozen, I don't know, there are probably 4 dozen if we really look into the Rolodex of lenders
Mhm.
who would want to lend on free and clear land.
Yeah. So let's dive into the specifics here just a little bit because I think it's really interesting. On the Markham deal, right? We bought a property, we tore down the structure, and now we're left with this land. So we have land that's worth about, let's call it $300,000. Most lenders are only lending 50, 60% on land and really 70% if it's permitted and you really have all your ducks in a row, and that's of cost. So what we could get for our cost on that is we could get $210,000 if it was permitted, right? And it's not permitted right away. So let's work with $180,000. We have to come out of pocket $120,000 to complete that purchase, plus have the capital available to do any other things like the actual demolition, the grading of the land, etc. When we go back to Alcott with keeping the structure, we're still going after creating lots. It's the same end goal. The end goal is to still get lots, but because we're keeping the house, we have lenders that will come to us and say, "Yeah, we'll fund 90% of your purchase and 100% of any sort of stuff you have to do to get those lots." So if that was $300,000, we'd be getting $270,000 towards the purchase, plus they'd be covering any of the other stuff. So you can kind of see how keeping the house in the event that it's there and the opportunity presents itself can actually be super beneficial.
Yeah, and there's a base cost on both your time and your money that, like, ultimately, when we talk about the Markham Washington deal,
Mhm.
we were just like, you know what? We're going to need X dollars of equity anyway to complete the construction. Let's just buy it with just the equity raise and we'll just get optimal financing on the second go around to go vertical versus when on the Alcott deal, you're talking about a quarter of the equity out of pocket. It makes sense paying those processing fees and putting in the time to talk to other lenders about it.
Yeah, I mean, there are some obviously some external factors, like that Markham deal is still a slam dunk in my opinion. I love that. We just decided not to take that debt on the front end. We decided to fund it with the capital because, as you said, we already were gonna need that capital for other things. So we raised the equity, we made the purchase, and we're just kind of waiting until we have permits in hand in order to get the debt. But that's in a better neighborhood, right? That's a different product than what we're selling on Alcott.
Yeah, that one we were going in the strategy of a for sale, and look, we had a lot of really good comps. We actually since then have actually lined up the financing, which is it's documented everything, and money just gets released once the permits are in hand. Like we ended up doing the right thing there. Versus Alcott, we're talking about build to rent also, which, financing the steps you take to get to that financing, that end financing, your permanent financing, can be a little bit trickier and matter a little bit more on how you get there in terms of ultimately your levered returns.
Yeah. Yeah, that makes a lot of sense. And I think I do want to bring one more deal that we're working on that we actually just closed on today, um, to this scenario because it's something a little different than we're really talking about, right? We're talking about a scenario in which we purchased the land that was already subdivided. There was no development that we needed, and we have a clear path to get permits in hand, right? What does raising capital look like for that, including just like funding it ourselves?
Yeah, so we raised equity. Again, it sort of actually does have some similar qualities of the Markham Washington deal because, we have raw land that we are going to go then permit. But what we have there is there's no subdivision risk. We're building a house that we've already built. There are a lot of good direct comps. And so there's low risk there. And so across the board, we can get good leverage on the loan and then also have decreased risk to our capital partners where it's just a super straightforward deal. And we're willing to get really aggressive ultimately once we have a permit in hand with the loan. But buying cash allows us ultimately with the permit in hand to go be more successful getting the leverage that we want on it.
Yeah. We just evaluate all of our options upfront before we dive into it, and I think that allows us to make the right decision, even if it's, "Hey, let's purchase it cash," right?
Yeah, and ultimately that's a scenario where we can test out a new lender we
Yeah.
want.
Yeah, a lot of lead time. I think that makes a lot of sense. This actually dovetails kind of nicely into what I would consider to be like the meat of like what's important here, right? And how does this impact our profitability? How does this impact the way we take capital from our investors and pay our investors back? And I think one thing that's worth pointing out is traditionally speaking, like I said, our deals are, but it's by right development. And so while it is pretty straightforward, it's a little bit off the beaten path of traditional real estate investing. And because of that, we reward our investors. We're typically paying something like 25% to our capital partners, right? And I get this question all of the time where on Sherman for these duplexes that we're building, we took a development loan just to allow us to purchase and tear down a house. And we paid something like 3 points and 11.5%, which on an annual basis is 17.5%. And I get the question, well, like, that's a lot of money. That's a lot of interest. But like, that's subjective, right? Why do we still feel like that's a good deal for us?
Yeah, I mean, that one ended up being a much better deal. Also, we got positive appraisals on there. We got a very high loan. And what we were looking at is we were raising equity just for the development phase there, which is even riskier. We were offering initially projected, I believe, in the 30s, something
Mhm.
around there for just the development loan, something quick and what otherwise could potentially be risky. Well, riskier. As we talk about return and risk, and why our limited partners are actually were excited to get a bigger loan there. I mean, we needed less equity capital. So the splits actually helped everybody. When you talk about paying 17%, because 17% relative to 30 something, that's a win for everybody. Win for us, win for the limited partners, and ultimately, I guess a win for the private lender there who got a deal that they otherwise wouldn't get.
Yeah. I mean, there was a lot there, but I think specifically, I mean, we know this, right? When someone comes up to me and says, "You're taking a loan that is essentially 17.5%, isn't that a lot?" How do we respond?
It costs less than equity. Like it's that simple. Like, how much money do you want to make on your cash? Oh, you like to double your money in a year? That's a really high return. If you were just like thinking about it, or you want to double your money every 2 years, doubling your money every 2 years is like a 36% return or something like that, right? Like
Yeah.
so paying somebody 17% to help you get there faster, always worth it. I shouldn't say always.
People
Accounting for these other risks, yeah.
people in today's real estate environment get tied to these numbers like, oh, mortgages are at 6.5%. That's high. But like everything is really subjective, right? Mortgages being at 6% is really high right now. Specifically, even compared to like the 18% it was in the past, because housing prices are just higher, right? So in this particular case, saying 17.5% is high, that doesn't really mean anything, right? I would take a 50% loan from somebody if I had a guaranteed 100% return on the other side, right? It's really all subjective here. And so when someone comes to us and says that's expensive, it's exactly what you said, right? Like our returns are going to be higher than that. And if we weren't taking the money from there, the other place we'd be taking the money from is just more expensive. And so it's worth it for us.
Yeah, ribeye is more expensive than flank steak, right? It's because ribeye tastes better.
Yeah, that's right.
It's like it's worth more. That's why it costs more.
And so there is the other side of this coin, right? So this deal on Lavender that we're closing on today, right? We have a capital partner who we are actually paying. I think it's like something like 15%, and then
Yeah,
part of the profit sharing. It's a little bit lower than traditional, and she's actually really happy with that, right? So why is she happy with that, even though our other projects are in the 25 to 30%
yeah.
range?
So it's got a shorter timeline, and it's simpler. It doesn't have the subdivision basically, and we had a lot of really good comps, and it's just like super easy to explain to anybody. You could explain it to a middle schooler, and they're going to be like, "Okay, I understand what's happening. You bought some land, and you're building a house, and then you're selling it." And so something that simple to ultimately give returns that are in the 20s, it's really difficult in this market to find that elsewhere. And I think this capital partner, I mean, you talked to her a little bit more, but what's her money getting in the bank right now? 3-4%. So yeah, the risk adjusted return to get into the 20s there, like, even if we screw up, she's probably gonna get her 15%, like, in a year. That's worth it.
Yeah. We always tend to look at, how poorly would this deal have to go for the returns to be, for like the pref to be taken away from an investor. And it's usually not even something we can imagine, right? Like there's so much profit after the pref that's paid out that we generally like can't even imagine like that dipping below 15%. And again, this is just purchasing a lot and then building a house on it and selling it. we like to talk in baseball terms, right? We like singles, doubles, home runs, grand slams, right? Everyone likes to say everything's a grand slam. It's amazing. It's a home run, but we love calling this a ground rule double. Like, why is this a ground rule double for us?
Yeah, it's locked in. I mean, it's like we got a great deal on the land basis. Also, that's something. I mean, I literally was texting with another builder today. I texted him the lot, and he was like, "Oh, that's a great price." I was like, "No, that was the ask. The ask was 95,000. We got this lot for 60,000." So
Mhm.
another builder thought there was profit in the deal at the ask of 95,000. For context, so that's 35,000 of potential buffer when we think about the way other builders are looking at the deal. So that's one component here. As I already talked about, the simplicity of this is another component. We know what's going to happen. There's very little variability. Sort of like, when you think about a ground rule double, you're definitely getting to second base. That's why we talk about it in this way. We also talk about like limited upside in there. Like, it's not like this market is going to all of a sudden explode or there's the potential for an extra lot here. So it's not a home run, but like, we're pretty sure we're getting on base here. We're going to get there to the second base. But yeah, we're not subdividing where we're going to get incredible outsized returns or anything like that.
I mean, if I walked up to the plate in baseball and someone said, "Hey, you can just have second base right now. Like, you can't hit a home run. You'll have to wait till the next batter to score, but like you can get a double." Like, I'm taking it 100 times out of 100, right?
Yeah.
Yeah.
And this deal is that. I mean, it's as far as deals go by that we do, like this one is like really there as the ground rule double.
Yeah. So we've kind of talked about, how do we judge lenders from, a quantitative and qualitative standpoint? We've talked about debt before we even make our offer and how we manage these relationships with all of our lenders and the different types of deals. And then we talked a little bit about what that means for our capital partners and how the returns can vary based on risk and, how we're coordinating all that. And then I guess wrapping it up, like in terms of the importance of the company, right? I think that there are a lot of development firms out there that just say, oh, like we'll just get 80, 90% debt here. And then like, let's just focus on raising capital. But for us, we have like an entire division of our company dedicated to debt, right? Why is this so important to us?
Yeah, I mean, it's one of those things where like a lot of people don't realize it, and it was something I realized as a senior in college. Like everybody's focused on the stock market. I mean, this is just general companies' corporate debt. The bond market for corporate debt is substantially larger than the equity market.
Hmm.
So if you just think about, I mean, this is kind of like a more, I don't know how to exactly describe the metaphor, but like, yeah, if 75% of your capital is coming from debt and 25% is coming from equity, it's possible that that debt is 3 times as important as your equity. Just thinking about it like that. And so how it affects your deal and how can enhance your returns. I mean, most real estate deals, they're not on paper having this yield to cost in the double digits or anything like that. They're more like 7-8%. So if you can enhance that with your debt, it's basically required. If you're not utilizing debt correctly, you're never going to get those returns that make you competitive in the market. And so all of our competitors who are doing it appropriately are utilizing debt.
Yeah. I mean, I think we'll talk a little bit more about equity on a future podcast. And honestly, we talk about equity in every podcast, obviously. I do think it's a little bit misleading, of course. It's kind of like it's an oversimplified version to say 75% of your capital comes from debt. So it's 3 times as important. Like, because that 25% is the riskiest part. Like, that's harder to raise and harder to fund. But I mean, I think your point still stands and is super valid, right? Like, people say equity, 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 but most of your capital is coming from debt. Debt can take, I mean, we've had project returns in like the 12%, 13%, but then the actual profitability is over 100% on that project, right? So that just goes to show you, if we can leverage ourselves a little bit more with an additional 5% being covered through debt versus covered through equity, all of a sudden our returns are twice as good, right? And I don't understand why people don't focus on this more.
Yeah, I mean, I believe the deal you're talking about is like the Chamberlain. Like on
Mhm.
paper, when we were like doing the actual analysis on it, we are like, oh my god, this is only 13%. But like at the end of the day, we never came out of pocket more than $60,000 to rehab a house and then build a new house behind it.
Mhm.
And so we got something like at the end of the day, $115,000 back in our pocket on that 60, which technically we didn't double our money, but like for an 18-month investment, that's pretty good. And we sold that house really fast. It went for over ask. I mean, we made mistakes on that deal, and like those are the returns we made by doing like, I mean, little bit of a tangent, but we made the house too modern for the neighborhood. That was basically the mistake.
But we learn. We learn.
Yeah. And that's why we have these buffers in our deals, and we're conservative on things like that. Because even with those mistakes, those are the sort of returns that are possible by appropriately getting financing on the front end, who then was a different lender on the second phase of that deal, and having those connections to have somebody who really liked the rehab on the front end and then the new build on the back end, highly beneficial because it decreased our cash out of pocket substantially without changing the risk profile of the deal.
Yeah. And so that's why we've kind of made it a point to speak with. I mean, I like to say a new debt capital partner every single week, but I think realistically, like 2 to 3 a month is pretty good. We're going to events. I mean, we even got, it was how long ago was it that we both got a message in our inbox, and I was like, oh, this guy is trying to sell us some debt, and you were like, yeah, so is everybody else. And I said, well, let's at least give him a call. And you're like, it couldn't hurt, right? And now he's one of our
Yeah.
best lenders. So taking the time to respond to people who are reaching out to us with debt is proving to be fruitful. The last person who reached out to us for potential debt ended up being our equity partner on the Lavender deal, right? She was just
Yeah.
trying to lend money, and you kind of never know where that's going to go. But I think putting these benchmarks in place to speak with different lenders is how we are finding people who say, you know what, like our traditional product maybe doesn't work for you, but I know a guy who's willing to lend on a development loan, or we have this side fund where we're willing to fund what you're doing because we like what you're doing and we'll fund it as debt.
Yeah, I mean that goes to just talking to people in general in the industry, and making sure your network is right. And a lot of these lenders that you should be talking to, they know other people, basically. They know the other builders, they know what other people are up to. Sometimes they have good ideas that you should listen to, and sort of like, I mean, one thing we always talk about just in general, which is again a little bit of a tangent, but always be curious. We're always curious about what people are up to.
Yeah. I think we have this it's worth stating explicitly, right? Like we have decent, good, I guess, rapport with 30 plus lenders, right? You said 3 dozen, 4 dozen, like I'm there for sure. Realistically, we kind of narrow it down to about 10 that we want to use unless the terms change, because it's a lot to manage all those different lenders. We put them in a spreadsheet and we kind of understand what their pluses and minuses are, but realistically, there's only like 2 or 3 that are really competitive on each deal type. So going back to what we said before, we have deals where we're going to knock the house down. We have deals where we're going to subdivide the lots and either rehab or sell off the existing house. We have deals where we're just buying land. And these all fit within our criteria, our manifests of the deals we do. And we're really just keeping this list of all the different lenders that we have for the different deal types.
Yeah. Yeah, that's pretty that's a pretty good conclusion and summary of like what we're up to. And some parts of like I think we touched on the why we do it
Yeah.
and why it's so important, and we keep up with it, because the market does shift and we should be aware of those changes. New strategies come in, finding the right capital for those strategies. And sometimes those strategies actually come from the lenders, when they know what other people are up to also, because they're talking to other builders.
Yeah. It's more than just securing financing. It's more about like aligning the terms with the reality of the project. So that goes straight into our ability to execute predictably, right? Predictability, consistency, that's what builds confidence. And so knowing that we have these lender partners that we can work with that will fund us the way we expect them to fund us on the deals that we are confident in doing and have done before, allows us to basically avoid any unnecessary pressure. So we structure our debt thoughtfully. It's kind of like it's a tool in our tool belt, but it's the biggest tool in our tool belt a lot of the time, right? It's the money, and the money is what makes the deal happen. So if you are interested in how we approach this a little bit more, want to talk about it, we would love to connect with you. As we always say, we're super approachable, we're super around. You should come to one of our meetups. You can subscribe to our biweekly email. Connect with us on LinkedIn, connect with us on Facebook, Instagram. Make sure to like the YouTube video, subscribe if you want to see more of this stuff. And Devin, did I miss anything?
Yeah, like all our posts so the algorithm knows to send you more of our stuff.
Keep liking. We're liking our own posts to try to get it to you. Like your post to get it to your friends, because I think it's important. Thanks again, and let us know if you have any questions, and we'll see you in the next one.